All right, so Reliance just put out their latest earnings, and honestly, it's kind of confusing. You've got sales just crushing it, but then you look at the profits, and they're actually going down. So, what gives? How does that even happen? Well, that's what we're going to unpack today. Let's decode this thing.
And this right here, this is the whole story in a nutshell. Look at the left. Revenue, a big ol' beat. They smashed expectations. But then you look to the right, earnings per share, a miss. All that money coming in the front door just didn't make it to the bottom line. And that is the core conflict that investors are wrestling with.
So, what did the market think? Well, it gave its verdict pretty fast. The stock took a hit, down more than 1.5%. I mean, that tells you everything, right? Wall Street was way more spooked by the weak profits than they were impressed by the strong sales. So let's figure out why.
Okay, let's get into the nitty-gritty, the actual numbers. This is where you can really see that story of the beat versus the miss play out.
So check this out. Revenue came in at $3.65 billion. That's a nice beat over what analysts were expecting. But then you get to the earnings per share, the EPS, 364. Just a little light, a little shy of the consensus. But the number that really blows my mind is the tons sold. Reliance grew its volume by over 6% year over year. Now get this, the entire rest of the industry shrank by almost 3%. That's a massive, massive difference. It tells you they are absolutely taking share.
And that's it right there. That's the bull case. It's all about them just eating their competitors' lunch.
Yeah, and the CEO, Carla Lewis, she was not shy about it. She said, quote, "Our tons sold were a third quarter record and outperformed the industry by approximately 9 percentage points. 9 points. I mean, that's not just squeaking by. That is absolute domination in what's clearly a tough environment for everyone else." And this chart just paints the picture perfectly. Look at that. Just 2 years ago, they had about 14.5% of the US market. Now, they're sitting at over 17%. To grab that much share that quickly in a mature industry, that is no joke. That is some serious execution. So how are they doing it? What's the secret sauce? Well, according to management, it's not just a race to the bottom on price. Nope. They're pointing to their high-end customer service, making sure they have a huge inventory, and offering all these value-add processing capabilities. Basically, they're winning by being the best, not the cheapest. Okay, so that all sounds amazing, right? But, and there's always a but, all that growth didn't come for free. And that brings us to the other side of the coin, the bear case. And it's really all about one thing, margins. They were selling a lot more stuff, but making less money on each thing they sold. And the main story here, the thing that really weighed on the stock, was this idea of margin headwinds. Basically, profitability was getting squeezed from all sides. So why did the margins get crushed? Well, it looks like a perfect storm of three things. First, you've got a super competitive pricing environment. Everybody's fighting for business. Second, some of their really profitable high-end markets, like aerospace and semiconductors, saw demand slow down. And third, there was this funky accounting expense that we need to talk about. Okay, let's zoom in on this LIFO expense because this is a really big deal and kind of confusing. LIFO stands for last in, first out. The simple version is this. Because of how they have to account for inventory costs, it created a $25 million expense this quarter. Now, get this. In the same quarter last year, that same accounting rule gave them a $50 million income benefit. That's a $75 million swing in the wrong direction. That's a huge chunk of why the profit number looked so weak compared to last year. So you've got this tug of war, right? The bulls are pointing to insane market share gains. The bears are pointing to shrinking margins. So what's the tiebreaker? Well, it might just be what the company itself is telling us to expect. Let's look at the guidance. All right, so for the fourth quarter, management is guiding to what they call a seasonal slowdown. They see tons sold down 5 to 7%, which is pretty normal for this time of year. Average selling price, though, they think it'll be about flat. But the real key is that EPS range, 265 to 285. That kind of tells you that the margin pressure isn't going away overnight. And frankly, it was probably a little lighter than what some analysts had penciled in. So that leaves us with the big question, right? What do you do with a company that is just firing on all cylinders, executing flawlessly, but is swimming against a really strong tide in its industry? How do you play that? What's the call? Okay, so here's our take. We're calling this a market perform, but with a specific pitch, what's called a pairs trade. The idea is simple. You go long Reliance, you buy their stock because you're betting on their best-in-class execution. You believe they're going to keep taking share. But at the same time, you short a broad metals and mining ETF, something like XME. Why? Because that hedges you against all the nasty industry-wide stuff like weak pricing that's hurting everybody. So what you're really betting on is that Reliance will do better than its peers, regardless of which way the overall market goes.
And of course, please remember, this is not financial advice.